What if I told you there's a financial product backed by local governments and banks that promises a golden retirement for the elderly, beautiful performance reports for officials, and risk-free profits for the lenders? A perfect three-way win. It sounds like a dream, doesn't it? Well, today we're peeling back the curtain on this dream, because when a deal sounds this perfect, you have to ask the one question that matters. Who is ultimately left holding the bill? You think you're helping your parents plan for a better future, but you may have no idea that a meticulously designed trap is already closing around their pension, ensuring their golden years are anything but. Let's talk about something both surreal and gut-wrenching today. It's a new beast in the financial zoo called the pension loan. Think of it as a flash flood of financial engineering that recently stormed through rural commercial banks in provinces like Hunan, Sichuan, and Zhejiang. It was a whirlwind affair. After less than 3 months of fanfare, the authorities in Hunan slammed on the emergency brake. An urgent memo went out. Pull all the promotional materials, delete the articles, take down the videos. The shutdown was so swift, so absolute, that most people never even knew this scheme existed. This grand plan to borrow from the future to pay for today's retirement dream. Our story begins in Liling County, Hunan. Picture this. Countless families are looking at their parents who are approaching 60, the age of retirement. They check their pension eligibility, and a cold reality hits. Either they haven't paid into the system for the required 15 years, or they've only ever paid the absolute minimum, a paltry 300 yuan a year. If they want a more livable pension, they have one option: a massive, one-time, retroactive payment. To qualify for the highest tier, they need to cough up 6,000 yuan for each of the 15 years. That's a grand total of 90,000 yuan. 90,000 yuan. For an ordinary family, especially for an elderly person in the countryside, this isn't just a large sum, it's a mountain. It's the kind of money you couldn't find if you emptied every pocket and turned the house upside down. And just as despair sets in, a savior appears: the pension loan, presented as a joint miracle by the local bank and the Social Security Bureau. Don't have the cash? We'll lend it to you, up to 90,000 for this specific purpose. The interest rate is a conscientious 3.45% with a term of up to 15 years. Leaning in as if sharing a secret. Of course, the money doesn't touch your hands. It's wired directly into your Social Security account to make that lump sum payment. Then, once you retire and start receiving your monthly pension, the bank automatically deducts the principal and interest payment first. Whatever pocket change is left over, well, that's yours to spend freely. Incredulous, breaking down the absurdity. Did you catch that? In essence, you are using your own future, already meager pension, plus interest, to pay back a loan you took out today to inflate that very same pension. It's a dazzling financial magic trick, a sleight of hand that plays with time itself, building the win-win-win illusion. And why did this magic show become so popular? Because it painted a tantalizing picture of a triple victory, ticking off the points with a cynical edge. The local government and Social Security Bureau are ecstatic. They didn't have to spend a dime of their own money, yet their Social Security participation rates and contribution figures are shooting through the roof. Their performance reports are so glossy they practically glow in the dark. Look at Hunan. In just 2 months, they issued nearly 500 of these loans, totaling over 40 million yuan. Efficiency! The banks are grinning from ear to ear. In today's economy, finding good lending opportunities is tough. But this is a precision-targeted loan. The money goes straight into a government account, and the repayment source is the state-issued pension. On paper, it's a perfectly stable, closed loop. Business volume is up, interest is flowing in, and lending quotas are met. In Ibian County, Sichuan, the local government even subsidized half or all of the interest. For the banks, this was a guaranteed can't-lose bet. And what about the elderly and their families? Their immediate crisis is averted. They couldn't produce 90,000 yuan, but a loan took care of it. And they're thinking, well, at least we'll get a little more each month in the future, right? The sales pitch even whispered a comforting promise. If the elder passes away, the children won't have to repay the remaining debt. A thoughtful touch. Though, as we'll see, the devil is always in the details. So at first glance, the government wins data, the bank wins profits, and the elderly win a future. A chorus of hallelujahs. But as we all know, there's no such thing as a free lunch in this world. And behind this one lies a celestial price tag. We need to do the cold, hard math and see just how hollow that win really is. Dissecting the numbers. Let's take the poster child case from a Hunan rural commercial bank. A 90,000 yuan loan, 3.45% annual interest, 15-year term. The monthly payment comes out to 641 yuan and 19 fen. After this massive contribution, your newly upgraded monthly pension, by current standards, is 813 yuan and 48 fen. The bank deducts its 641 yuan and 19 fen, leaving you with the grand total of 172 yuan and 29 fen. The bank's brochure cheerfully points out that without this loan, you'd only get the basic pension of 166 yuan. So you see, you're ahead by a whole 6 yuan and 29 fen. What a windfall! A windfall of my foot. First, that 813 yuan pension only exists because you took on 90,000 yuan in debt. Without the loan, you'd have zero debt and a stable 166 yuan a month, which would likely increase over time. Now you're saddled with a crushing liability, and for what? An extra 6 yuan a month? What does that even buy you? A few discounted pork ribs if you're lucky?
What's more heart-wrenching is the opportunity cost. If you had put 90,000 yuan in a 15-year fixed deposit, the interest earned would dwarf this pathetic gain. You have essentially locked up a huge sum of capital in all its potential earnings for 15 years, just to get it back in microscopic monthly 6 yuan increments. The payback period is hopelessly long, the return on investment pitifully low. But the most critical point is this. For the next 15 years, the actual money you have to live on, to spend as you wish, is just 172 yuan a month. In the year 2025, with today's cost of living, 172 yuan doesn't buy you a dignified retirement. It barely buys you a dignified existence. Imagine working your entire life only to retire on a disposable income of 172 yuan a month. That's a life more bitter than wormwood. And the logic behind that conscientious 3.45% interest rate? It's lower than a consumer loan, sure, but it's higher than the 3.05% mortgage rate for first-time home buyers in the provincial capital. Think about that. They are charging a higher interest rate to the most financially fragile group, the elderly poor, than to young people buying property. The person who devised this is truly a master of predatory logic. And this whole scheme is a minefield of risk. For the banks, it's a bad debt accelerator. Their target clients have zero resilience to financial shocks. We're talking about rural banks whose risk management systems are, let's just say, not exactly Fort Knox. At the end of 2023, the non-performing loan ratio for rural commercial banks was 3.48%, far higher than the national average of 1.62%. What happens when a pensioner gets sick and withdraws their entire pension the moment it lands before the bank can make its deduction? The bank's only real leverage, the automatic deduction, is as fragile as a sheet of paper. If local pension funds run dry or a new regulation forbids such deductions, the banks will be left holding a pile of worthless IOUs. For the elderly, the risk is their very life. They are shackled. For 15 years, their disposable income is frozen at a pittance. A minor illness, a new set of clothes, a small red envelope for a grandchild. Every single expense becomes a source of anxiety. This isn't a pension plan. It's a life sentence of financial purgatory. And that fairy tale about the debt dying with you, it's laced with broken glass. The bank might tell you your family won't be responsible, but here's the catch. When you pass away, the remaining balance in your entire pension account, including the money you paid in yourself, is used to pay off the loan first. Only after the bank is made whole can your family inherit anything. In other words, before you leave a legacy for your children, you must first fill the hole for the bank. Even the local governments aren't safe. Those that offer interest subsidies are paying with real public money. If these programs scale up, that subsidy becomes a rigid, recurring expenditure, bleeding an already strained local budget. It's not a resource mismatch, it's planting a fiscal landmine for themselves. So why did Hunan slam the brakes so hard? First, the legality was shaky. It exists in a regulatory gray area. Second, the public opinion backlash was a tidal wave. Once the media did the math, headlines screamed about harvesting the elderly and pension Ponzi schemes. No one can withstand that kind of PR firestorm. And finally, sustainability. The entire model is a house of cards. One small gust of wind, a county where seniors start defaulting en masse, and the whole thing collapses into a major scandal. So, no, we shouldn't mourn the death of the pension loan. It was trying to put a financial band-aid on a deep, structural wound in the pension system. The direction was fundamentally wrong. It was more like a game of Russian roulette played with retirement funds, and when the game is over, the bank, the government, and the elderly are all left in debt. There is no financial magic wand to solve the pension crisis. The only solution is real investment from the state to raise the basic pension level. For individuals, it means planning early. And for financial institutions, if you genuinely want to serve the elderly, design products that are stable, transparent, and offer a real return. Stop scheming of ways to pass debt from one generation to the next. Retirement should be a destination for everyone. We hope for a future where the elderly have support and joy, not where they are shackled by debt until their last breath. When a pension itself needs a loan to be considered adequate, you have to ask, what is really being topped up? Is its value, or is it a burden that will take decades to unload? The answer is hidden in the cold models of the bank's actuaries, and it is written on the face of every senior trying to survive on a few hundred yuan a month. A clever loan, a triple prize, the bank and state's disguise. Borrow now to fill the pot. Your future pension pays the lot. But what's left is pocket dust, a life of want, a broken trust. A debtor's chain, a life of dread. The dream is gone, the promise dead.